Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NGL Energy Partners LP quarterly report. NGL Energy Partners LP offers a diverse range of businesses and services across three primary segments: water solutions, crude oil logistics, and liquids logistics. The water solutions segment provides water management services, including transportation, treatment, recycling, and disposal of produced and flowback water. It also aggregates and sells recovered crude oil, disposes of solids, performs truck and frac tank washouts, and sells produced water for reuse and recycle. In the crude oil logistics segment, NGL Energy Partners purchases crude oil from producers and marketers and transports it to refineries through various facilities such as pipeline injection stations, storage terminals, barge loading facilities, rail facilities, and refineries. It also provides storage, terminaling, and transportation services through pipelines and storage tanks. The liquids logistics segment offers natural gas liquids to commercial, retail, and industrial customers across the United States and Canada through its 5 terminals, third-party storage and terminal facilities, 9 common carrier pipelines, and a fleet of leased railcars. It also provides marine exports of butane and owns a propane pipeline in Michigan. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what could cause an energy company's stock price to skyrocket. The stock price of NGL Energy Partners LP has seen significant growth in the past year, and several factors may be contributing to this trend. One possible reason is the increasing demand for natural gas liquids, NGLs, due to their use as a feedstock in the production of petrochemicals and other products. As the global economy continues to grow, the demand for these products is likely to increase, driving up prices and profits for companies like NGL Energy Partners. Another factor that could be contributing to the stock price growth is the company's strategic investments in midstream infrastructure. By expanding its pipeline network and storage facilities, NGL Energy Partners can increase its capacity to transport and store NGLs, making it a more attractive option for producers and consumers alike. This increased efficiency and reliability can lead to higher revenue and profits, which in turn drive up the stock price. Additionally, changes in government policies or regulations may also be influencing the stock price of NGL Energy Partners. For example, if there are new tax incentives or subsidies for companies involved in the production and transportation of NGLs, this could make it more attractive to invest in these types of companies, leading to an increase in their stock prices. Finally, the overall performance of the energy sector as a whole may also be contributing to the growth in NGL Energy Partners' stock price. If the energy market is experiencing a period of high demand and low supply, this can drive up prices for oil and gas products, including NGLs, leading to increased profits for companies like NGL Energy Partners. Overall, it's likely that a combination of these factors has contributed to the growth in NGL Energy Partners' stock price over the past year. NGL Energy Partners LP maintains a market capitalization of $1 billion, broadly in line with the industry peer group. NGL Energy Partners LP trades at a lower price-to-book ratio of -9.22 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 85% of total assets. This elevated debt level warrants heightened caution, as it may limit the company financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. On the growth side, increased water disposal service fee revenues from contracted customers and higher reimbursements from construction projects are significant contributors. Additionally, crude oil sales have seen a substantial increase due to higher production on dedicated acreage in the DJ Basin. Other notable drivers of revenue growth include higher water pipeline revenue and expanded Lee County Express pipeline system. On the decline side, decreased butane sales and cost of sales due to lower prices and volumes are major contributors. Propane sales and cost of sales have also declined primarily due to the wholesale propane disposition. Furthermore, lower realized crude oil prices from the sale of skim oil barrels and expired contracts for pipeline revenue have contributed to revenue decline. It is essential to note that certain businesses within the company's liquids logistics segment are affected by seasonal fluctuations, particularly between June-December. Commodity price fluctuations can also impact revenue growth or decline. Understanding these drivers is crucial for making informed business decisions and developing strategies to mitigate potential risks. The net income of the company underwent significant fluctuations between 2024 and 2025. Initially, it increased from $14,575 to $48,189 in just 3 months, indicating a substantial growth. However, when looking at the 9-month period, the increase was even more pronounced, rising from $28,441 to $147,654. On the other hand, there were instances of decline as well, with net income decreasing from -$6,256 to $11,972 in 3 months, and from -$42,419 to -$18,915 over 9 months. In terms of profit margins, the operating income margin showed contrasting trends. It decreased from 8.6% to 12.1% in the first quarter, but increased from 10% to 13.7% over the 9-month period. The adjusted EBITDA margin also experienced a decline, dropping from 104.6% to 91.7%. These variations suggest that the company's profitability was affected by different factors at various points during the year. The company's financial performance has shown significant improvement in terms of operating cash flow. A comparison of the current year with the previous year reveals a substantial increase in net cash provided by operating activities. In 2025, the company generated $240,475,000 in operating cash flow, a notable rise from the $122,498,000 recorded in 2024. This upward trend indicates that the company is successfully managing its operations and generating sufficient cash to meet its financial obligations. As a result, it can be concluded that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have undergone changes over the past year. While there are mixed signals regarding these changes, some trends emerge from the data. In terms of debt levels, long-term debt has decreased in some areas, such as senior secured notes, Term Loan B, and ABL facility. However, it has increased slightly in other areas, including a total debt increase of $2,971,064 at December 31, 2025. Interest expenses have generally decreased or remained stable over the past year. The interest expense for the 3 months ended December 31, 2025 was -$63,834, which is a decrease by $0 compared to the previous period. Additionally, total interest expense decreased by $600,000 and $15,890,000 in different periods. Overall, while there are some fluctuations in debt levels and interest expenses, there is no clear indication of a significant increase in these areas. The company's financial situation appears to be stable, with some decreases in debt levels and interest expenses. The company's financial performance can be analyzed through various segments and regions. On the positive side, service revenues saw a significant increase of $345,000 to reach $597,000. This growth indicates a strong demand for services offered by the company. On the other hand, certain areas showed decline or poor performance. General and administrative expenses witnessed an increase of $1,915 on one page, but a substantial rise of $5,718,000 on another, indicating inconsistent trends. Depreciation and amortization expense also presented mixed results, with a decrease of $20,000 in one instance and an increase of $341,000 in another. Overall, the company's financial performance is marked by both positive and negative trends across different segments and regions. Management's outlook for the company is centered around a strategic shift in operations, driven by the sale of refined products business and winding down of biodiesel business. This change will significantly impact financial results going forward. To improve performance, the company plans to dispose of non-core assets. The growth strategy focuses on operational efficiency across all segments, with a strong outlook for the water solutions segment and a positive outlook for the liquids logistics segment. Financial flexibility is maintained through managing working capital borrowing needs. Capital expenditures are expected to be around $220–230 million in the fiscal year ending March 31, 2026. The Board of Directors will evaluate reinstating common unit distributions based on leverage, liquidity, cash flows, and overall performance. The company also faces potential increased compliance and operating costs due to proposed environmental legislation. Management attempts to balance contractual portfolio risks through strategic purchasing decisions. The company has made several significant transactions in the form of acquisitions and divestitures. Notably, there are no recorded acquisitions mentioned in any of the provided pages. On the other hand, the company has engaged in multiple divestiture activities. One notable example is the sale of its refined products business, which was completed as part of a larger effort to wind down its biodiesel business. Additionally, the company sold certain investments in unconsolidated entities and related assets on April 14, 2025. Furthermore, it disposed of its wholesale propane disposition through multiple transactions, including the sale of certain natural gas liquids terminals and most of wholesale propane business on April 30, 2025. These divestitures demonstrate the company's efforts to restructure and optimize its operations by shedding non-core assets and businesses. By doing so, it aims to focus on more strategic areas of growth and development. And there are concerns about inventory buildup and supply chain disruption based on the extracted summaries. In terms of inventory buildup, there is evidence to suggest that the company has been experiencing an increase in crude oil inventory levels over time. For example, pages 65 and 77 indicate a significant increase in crude oil inventory by 154,000 barrels. Additionally, page 45 shows a negative value for crude oil fixed-price inventory, indicating a liability. Furthermore, commodity purchase commitments increased in 2026, page 33, which could imply potential concerns about inventory buildup. This suggests that the company may be struggling to manage its inventory levels and may be at risk of overstocking. In terms of supply chain disruption, there is limited evidence to suggest any significant disruptions. However, page 47 indicates a decrease in butane and propane sales for the liquids logistics segment, which could imply some level of disruption. Additionally, page 92 mentions periods of short supply, which could imply potential concerns about supply chain disruptions. Overall, while there are some indications of inventory buildup and potential supply chain disruptions, further analysis is needed to fully understand the extent of these issues. That concludes the financial summary for NGL Energy Partners LP. Feel free to comment below, and I will be happy to answer them when possible.